The Intelligent Investor by Benjamin Graham is one of the most influential books on investing ever written. First published in 1949, the book has been read and loved by millions of people around the world. It is a guide for investors who want to make informed decisions and avoid costly mistakes. The book is divided into 9 chapters, each of which explores a different aspect of investing. In this summary, we'll explore the key themes and concepts of the book and provide personal insights and reflections on how the ideas in the book can be applied to real life. You can visit the link in the description later to buy a copy of this book. Chapter 1: Investment versus Speculation. The first chapter of the book sets the tone for the rest of the book. Graham differentiates between investment and speculation, emphasizing the importance of investment that is done intelligently. He argues that investing in stocks is not the same as gambling and encourages investors to approach the market with a long-term perspective. He stresses that the intelligent investor must be disciplined and rational, avoiding the emotional highs and lows that often accompany investing. Chapter 2: The Investor and Inflation. In this chapter, Graham emphasizes the importance of understanding the impact of inflation on investments. He suggests that investors should focus on companies that can maintain their earning power despite inflation, and also highlights the importance of diversification. He explains that inflation is a silent thief that eats away all the value of money over time, and that investors must take steps to protect themselves against it. Chapter 3: A Century of Stock Market History. The level of stock prices in early 1972. This chapter provides a historical perspective on the stock market and examines the level of stock prices in early 1972. Graham suggests that investors should be cautious when buying stocks, as high stock prices can be a sign of overvaluation. He explains that stocks should be valued based on their earning potential rather than their popularity in the market. Chapter 4: General Portfolio Policy. The Defensive Investor. In this chapter, Graham outlines a general portfolio policy for the defensive investor. He suggests that investors should focus on buying stocks that are trading at a discount to their intrinsic value and should also diversify their portfolio. He explains that the defensive investor should take a conservative approach to investing, avoiding risky or speculative investments. Chapter 5: The Defensive Investors and Common Stocks. This chapter provides a more detailed perspective on investing in common stocks as a defensive investor. Graham suggests that investors should focus on buying stocks that have a long history of earnings and dividend payments. He explains that these stocks tend to be less volatile than others and that they provide a steady stream of income for investors. Chapter 6: Portfolio Policy for the Enterprising Investor. Negative Approach. In this chapter, he outlines a portfolio policy for the enterprising investor. He suggests that investors should focus on buying stocks that are undervalued and should also look for opportunities in special situations. He explains that the enterprising investor must be willing to take calculated risks in order to achieve above-average returns. Chapter 7: Portfolio Policy for the Enterprising Investor. Positive Approach. This chapter provides a more detailed perspective on investing in stocks as an investor. Graham suggests that investors should focus on buying stocks that have a long-term potential for growth and earnings. He explains that these stocks tend to be more volatile than others, but that they offer the potential for significant gains over time. Chapter 8: The Investor and the Market Fluctuations. In this chapter, Graham emphasizes the importance of understanding market fluctuations and not being swayed away by short-term changes in stock prices. He suggests that investors should focus on underlying fundamentals of the companies they invest in and should avoid being overtly influenced by market sentiment. He explains that the intelligent investor must be patient and disciplined, avoiding the temptation to make impulsive decisions based on short-term trends. Chapter 9: Investment versus Speculation. Results to be expected by the intelligent investor. The final chapter of the book summarizes the key themes and concepts of the book. Graham emphasizes the importance of investing intelligently and avoiding speculations. He suggests that investors should focus on buying stocks that are trading at a discount to their intrinsic value and should also diversify their portfolio. He explains that the intelligent investor must be disciplined and rational, avoiding the emotional highs and lows that often accompany investing. Overall, the intelligent investor offers a comprehensive guide to investing intelligently and making informed decisions. The book provides a historical perspective on the stock market and emphasizes the importance of understanding market fluctuations. It offers practical advice on how to invest conservatively as a defensive investor, as well as how to take calculated risks as an enterprising investor. Reading The Intelligent Investor was a transformative experience for me. As someone who's always been interested in investing, the book provided me with a more comprehensive understanding of how to invest intelligently. I learned the importance of focusing on the underlying fundamentals of the companies I invest in and avoiding speculation. I also learned the importance of diversification and avoiding being overly influenced by short-term trends. One of the most valuable lessons I learned from the book is the importance of patience and discipline in investing. It can be tempting to make impulsive decisions based on short-term market trends. But the intelligent investor must be willing to take a long-term perspective and avoid the emotional highs and lows that often accompany investing. Another important lesson I learned from the book is the importance of understanding the impact of inflation on investments. Inflation is a silent thief that can eat away the value of money over time, and investors must take steps to protect themselves against it. By focusing on companies that can maintain their earnings power despite inflation and diversifying their portfolio, investors can protect themselves against the ravages of inflation over time. In conclusion, this book is a must-read for anyone interested in investing intelligently and making informed decisions. It provides a comprehensive guide to investing, emphasizing the importance of discipline, patience, and a long-term perspective. Whether you're a seasoned investor or just starting out, this book offers valuable insights and advice on how to make the most of your investments. There's a link in the description below that you can use to buy this book, which helps us create content like this for free.